What's going on, guys? I'm gonna show you guys how to scan for momentum stocks and how to catch them as it's happening and how to trade it profitably. So let's get this started. The concept behind this is you want to, like it says, catch the spike that most retail traders miss because their high-a-day scanners are just giving them a fire hose of information, and it's hard to filter out what has volume, what is up on the day, um, what type of spike is it, how big of a spike um, is it a low float, so on and so forth. So what we want to do is focus on stocks that have the ability to make big percent moves and enter just before the rest and ride the momentum of all the noobs that will likely chase any spike up as as chat rooms continue to alert them and say, oh, this stock's spiking, and the people see it and they go, oh, I'm going to buy, and it just continues to squeeze up. So we want to establish a good risk-reward trade on a setup that has very limited downside with a potential upside of 20+%. Here's a quote from George Soros that I like a lot. He says, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. And that's what I meant by this establish a good risk-reward trade. So you gotta be able to make at least 2 to 1. If you're risking 4 cents, you got to be able to make 8 cents. Or if you're risking 6, you got to be able to make 12. If you're risking 10, you got to be able to make 20. And so on and so forth. And so what I'm going to show you is a good risk-reward setup and how to trade these spikes profitably. So what does this setup look like? This setup particularly looks like this. So NADL is a stock that spiked up and hit my scanner that I'll show you guys how to build later. That when it spiked up, it spiked particularly right here. It spiked right there, and then it put in this consolidation and it continued up. So this spike right here is what I'm scanning for. I want to find that spike as it's happening, as it's hitting other people's scans, and then I want to wait for a probable setup that I'm ready to trade, that I think is a good risk reward, because a good risk reward has an established risk level and a potential upside. So here's what we're looking for again. Here's another setup. This was MSDI. MSDI was doing nothing on the day so far, and then had this little perk right here. This particular stock is a former runner, and this one had a catalyst. NADL, there was no catalyst. They're going bankrupt pretty soon, but I don't believe that was a catalyst. I think this was simply just a short squeeze. So the catalyst here on MSDI was a merger. So they were saying that they are being bought out or they're buying or something like that. I don't know. I don't really care. So the idea is that you see this perk, you see the pullback, and you get the continuation. So here's another setup. Here was ABIL back on the 24th. Exact same scenario. So at the market open, it didn't really do much. The volume was light. It pretty much sucked. There wasn't much going on, and then it had this spike over the next 4 minutes, and then a pullback, and then a continuation. So this is what you're looking for: a quick spike, some pullback, and then a continuation up. And then you want to enter when it breaks to a new high, risking this low of day right here. People most commonly know this as a bull flag. So this is a bull flag pattern. How to trade a bull flag pattern profitably with an established risk level, and how to scan for stocks that can give you bull flags with a lot of potential upside. So let's take a look at the setup. So how do you know what to look for. So what you want to look for is you want to make sure that it is a low float. So a low float is something that's 10 million shares or less. It's got to be hitting new highs of the day. I don't want something that's down on the day that's having a spike off of the bottom, because that's not this strategy. This strategy is buying things that are hitting people's high-a-day scanners, that's going to have momentum, that's going to have a lot of upside, and it's not going to have resistance directly above it on the day. Whether it has it directly above it on the daily chart is a different story, but the idea here is you want something that's just going to pop really quick and you got to get out. This is a day trade, not a swing trade. So you got to be ready to get in and you got to be ready to get out when your profit goals are hit. Don't stick around thinking that, oh, there's more on the table. Oh, take the meat of the move and get out. So, like I said, it's got to be green on the day with a spike that has much more volume than the rest of the day. So if we look back here at, say, NADL, look at what it did in the day. Pretty much nothing, zero volume, but look at this big volume spike right here. And then you get this big volume candle, and then you have a big price jump too. This price jump is what you want to find. This volume is what you have to look for. So you're not going to scan for volume per se, you're going to scan for a price jump, and then you want to look and wait for the volume to happen. And you want people to be buying this, and then you want it to consolidate sideways or a little down, but you ideally want some candles in between there. MSDI, for example, again, it did nothing on the day, and then it popped at the end of the day. This is around 2:20, 2:18 Eastern time in the afternoon. So it pops, does nothing, or it pops, has one candle. These are the quick ones that you got to be ready for. This candle is established to give you your risk level, which is at the bottom, and your entry level, which is at the top, on the next candle that makes a new high on good volume. So look, it pops, red bar right here, consolidates. This little red, sellers were in control here. Then buyers came back in control, and we broke out right there. And we continued on upwards from there. But your risk level is down here, your entry level is up here, but I'll get into that a little later. So, like I said, it's got to be green on the day. It's got to have a spike with much more volume than the rest of the day, as you can see on those other days. Ideally, it's a former runner. Ideally, it has a catalyst. And the most ideal setup is it's a former runner with a catalyst, like MSDI was. These will spike the most. So you can see here, this one was down. This was 70 cents, and the spike went all the way to $1.20. There was actually two halts in here. So this little candle right here that has no volume, that was a halt, volatility halt. So it really got moving. But you had the opportunity to enter when it hits the scan. You got to be ready to trade it, and you got to be ready to enter when it breaks that high. So the less ideal but still tradable was like NADL, which is it's still a former runner spiking without a catalyst, or it's a stock that isn't a former runner but still has a solid catalyst. But NADL, this one here, was a former runner, but there really wasn't a catalyst. But you still got a decent spike. This one was only about a 20% spike, whereas MSDI was about a 40% spike. Same goes for ABIL. This didn't have a catalyst. It was just this is a small, it looks about like a 20% spike as well. So you can see how when it's a former runner with a catalyst, it's low float, it's hitting new highs in the day, it's green on the day, there's much more volume coming in, you're going to get a big spike. When it has one of these but not all, it's less ideal, but it's still tradable. So how do you scan and find these stocks? Here's how you do it. You use a scanner like Equity Feed. which is, in my opinion, more reliable um, than stocks to trade. You can also use stocks to trade. I had stocks to trade, it just wasn't very reliable for me. It always crashed at peak hours. But Equity Feed has been around for a long time. They're perfect for scanning for lower price stocks. And I'll leave a link in the description of a 10% discount for Equity Feed, monthly discount. So if you click that link down below, then you can get a 10% discount. They'll give you a 2-week trial, no strings attached. You don't put any credit card information whatsoever, just your name and your email, and they let you try the software free for 2 weeks. I highly recommend it. But again, if you're a stocks to trade user, that's perfectly fine. You can still scan for the same stuff. So you want to be reactive, not predictive. So what I mean by that is you want to react to the price action. Don't try to predict the price action. So if it spikes on you really quick, you see it hit the scanner, you pull it up, there's the quick spike, you're like, ooh, let's trade it. No, don't. Wait for the setup. Wait for the right setup, and don't trade everything that hits the scanner, okay? You'll see a liquid, non-volatile crap, but it'll disappear quickly since the scan's only for stocks with momentum occurring in the moment. So it'll end quickly. It'll drop off of the scanner if it's not volatile and if it's illiquid. But you want to pull them all up. You want to look at them. You want to look at the chart. You want to see what's going on. Is it breaking to a new high a day? Is it form a runner? Does it have a catalyst? You may not have time to check for the catalyst. You may just have the only opportunity just to look at a one-year chart and see if it's a form a runner and it's the right setup like NADL and MSDI and ABIL. I mean, those things spiked fast and had a very quick pullback, MSDI and ABIL did, and you had to be very reactive. But you don't want to sit on your hands and wait. So the idea is that there is a risk level and that there is a reward, and you got to respect that. So here's the scan criteria. This is my formula. This is how I find them. And this is what other people are looking for as well. So you got to remember what we're looking for. We're looking for a low floater, hitting new highs of the day. It's low priced, it's a former runner, and it's on an above average volume and price spike. So your scan criteria is going to be a price greater than or equal to a penny and less than or equal to $10. With a float less than or equal to 10 million shares, and here's the special ingredient. It's a 10-minute percent change greater than or equal to 6%. This is why they'll pop up and disappear. So if they're not making big percent gains in a short period of time, they're going to disappear. This is not going to catch those stocks that grind all day up, that get finally to like 13% up on the day. I don't care about that stuff. I want volatility. So let's build the scan. I'll show you guys how I build my scan inside Equity Feed, and you can see exactly how I do it. So let's bring this in here. Here's Equity Feed. Here's the filter builder. You click this button, it's going to bring up this right here. This is your filter builder. You're going to look at your price data. You're going to click last, and you want it to be greater than or equal to a penny. Add to query. Last, double click it. You want it to be less than or equal to 10. And now percent change. This is the secret ingredient. You want a 10% or a 10-minute percent change greater than or equal to 6. Everybody's asked me, a lot of people ask me, you know, why 6? Why not 10? Why not 5? Why not 2? Why not 20? Because 6% is generally the percentage of those spikes that hit new highs of the day that grab people's attention. So generally these stocks are up on the day already, and when they have this 6% spike, then they're generally probably hitting other people's scanners that scan for things that are up 10% or more on the day. So it's hitting other scans, it's giving me the volatility that I want, and it's going to give me the opportunity to trade it quickly. And the final thing here is fundamentals, share structure, float, less than or equal to 10 million. Add to query. Run a filter. And you get a filter that looks like this. Nothing. It's nothing because it's obviously the market's not open, and you're going to see a blank filter for most of the day until something hits. You'll see it pop up, and you need to be very reactive. You need to jump over to your broker, to your platform, pull up the 1 minute chart, look at it. What type of spike is it? Is it hitting a new high a day? Is it a former runner? Does it have a catalyst? Is it above average volume? Do you see a lot of prints going through on the time and sales, or was it just 1, 2 prints that's popping it up? If that's the case, don't trade it, don't touch it. It's a liquid, you don't need it. So anyway, let's jump back to the presentation here. Okay, maybe there, Jesus, okay. All right, so let's look at how we trade it. So here's ABIL, NADL, and MSDI, okay? This is what you do. You want to wait for a bull flag pattern. So that pattern again is a spike, a pullback, and then a continuation. So this spike, the red candles, you ideally want 2 to 4 red candles in between there, and that's going to give you a good consolidation levels like NADL right here. See that 4 candles in between there, and you've got a risk level down here and a reward up here, or sorry, an entry up here. So this is what you're looking for. And again, here's MSDI. It did nothing until 2:20 in the afternoon, and then boom, here you go. Or 2:40 something. Yeah, 2:40. Yeah, 2:40 in the afternoon, and then same kind of results right there. This one, ABIL, was a morning spike. NADL was a kind of a delayed morning spike. It was still morning. It was only 10:20 Eastern, but this was an end of day. I don't know if this really works midday. Hadn't really tried it too much, but we'll see. So you wait for the bull flag, and then your pullback is necessary. You have to have that. This establishes the risk level, okay? Ideally, like I said, you get 2 to 4 red candles in between. You want that to be on light volume, but it's not necessary. But as you can see here, the red candle, what happened? The red was a light volume compared to the green. This shows that there's not a lot of selling pressure and there's a lot of buyers here. This is simply just healthy consolidation. Same thing goes here, big green candles, lighter red candles. Or yeah, big green candles, big green volume spike, light volume, so you get a good volume profile. And then here you go with MSDI, same thing, volume spike, equal red volume, but or a little bit less, not really very much, but a little bit less. And then you add a continuation up on good volume. So you don't have to watch these volume bars. Really what you're going to watch is your time and sales tape and all the prints going down, 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 and you start seeing it spike and spike and spike. And as soon as it breaks that top is when you want to enter. So if that top is at $1, you want to enter at 101, you're going to be risking down here at the bottom. So again, you wait for it, and sometimes you just get one red candle and then the continuation like MSDI and ABIL. So be ready and respect your risk. If the trade doesn't work, get out. Cut the loss quickly. Move on. Live to trade another day. So your entry is the first green candle to make a new high on good volume, and your risk level, or the level where you cut your loss, is the lowest wick of the candles in the bull flag. Okay, so let's take a look at that a little bit more in depth. So here's MSDI. This is the one we looked at. We want to trade this one. We see it pop up on our scanner. We see this little spike here. We see the top at 70 of this right there, and we got a bottom here where it touched 66. So we're ready to enter when it breaks 70. So what do? You buy it at 71 when it breaks to the upside. And where are you risking? You're risking down here, and you're risking 4 cents from 66 to 70. That's a 4-cent risk. Or if you're entering at 71, it's more like 5 cents, but you get my point here. So what does that look like? Here's how you size your position using a 4-cent risk. This is how I do it. So if you want to buy 1,000 shares at 71 cents, you're risking roughly 4 cents. You're going to take a $40 loss if you have to lose. Or 2,000 shares, you're taking an $80 loss. Or you buy all the way to 10,000 shares and it's a $400 loss. It's whatever you're comfortable with. Size in according to your comfort level. Me, I've taken some small size so far, and I'm only doing that because I'm still testing this. So let's look at another one. So here's NADL. So again, NADL is that ideal bull flag setup. You get the spike, the 4 red candles with the little green in here. This could have been red, it could have been green, it doesn't matter. But ideally you get 4 sideways candles. You got a risk level here at 130. You got an entry level at 135. So what do? You buy it at 136 as soon as that candle breaks. Where is your risk level? It's 130. You're risking 6 cents. So how do you size in? You look at it like this. You got 1,000 shares. Your trade goes wrong, doesn't work out. You're taking a $60 loss. 2,000 shares, $120 loss. 10,000 shares, $600 loss. You get the point. Size in from there. Now, when do you take profits? So here you go. On stocks that are $5 and under, the goal is to make 10 to 20%. Okay, so for stocks like NADL, this particular case, here's my verified trade on NADL, and I used this strategy in this scanner. I bought it right at 136, like I said I was going to, and I sold at an average price of 161. Now I only bought 1,000 shares, and I made 250 bucks, but that is an 18% gain. Now if I would have bought 10,000 shares, what would I have been risking? I would have been risking approximately, let's look back here at NADL. I was risking 6 cents. I bought 10,000 shares. I'm risking 600 bucks. But if that's the case, then my potential upside, you can see, I would have made 2,500. So if I'm risking 600 to make 2,500, then I have roughly a 4-to-1 risk reward, which is a very, very ideal trade, and you should take it all day, every day. And if you get a stock that's over 500 bucks, then your goal is to make 30 or 50 cents a share and get out. So your goal is to sell into this spike right here. It's not to spike, let it go, and then see where it pulls back, because this could just be a and then a done, one and done. But you want to be ready that way in case it goes the other direction, you're prepared. And you want to sell into this spike, and you want a profit goal of 10 to 20% if it's under 5 bucks. If it's over 5 bucks, you want to make 30 to 50 cents a share, and you want to trade it just like that right there. But thanks for watching, guys. I hope this has helped everybody out, and if you have any questions or anything like that, let me know. And again, don't forget to click the link at the bottom of the page or in the bottom of the description there. That will have the 10% discount on equity feed. And I hope you guys have a good night, and we'll see you tomorrow in the chat rooms.